All right. Welcome. This is the easiest transition as the host and moderator right into moderation. That said, I want to welcome each of our panelists. Quick introduction. Ryan, let's start with you.
Yeah, great to be here, Kyle. Thanks to the Stacks team. My name is Ryan Rasmussen. I'm a senior research analyst at Bitwise Asset Management. We're one of the largest crypto asset managers in the US and launched one of the recent Bitcoin ETFs. So excited to be here talking about Bitcoin ETFs, institutional adoption, and love everything going on in the Stacks ecosystem.
Awesome. Thank you, Ryan. Chiente.
My name is Chiente Xu. I have been on the TradFi for more than 25 years, building quant businesses. And right now, I'm building Alex together with my wonderful team. We are #1 Bitcoin DeFi, and that's what we are doing.
Awesome. Ellie.
Hi, Ellie. I'm the head of strategy and business development at 21 Shares. 21 Shares, we are the world's largest crypto ETP issuer by the number of products globally. We recently launched spot Bitcoin ETPs as well here in the US. Quite excited to be here and talk about all things Bitcoin, Bitcoin 2.0, Stacks, the Nakamoto release, and more. Quite impressed with everything that you guys have done since Blockstacks. So excited to be here.
It's exciting to have each of you. And there's so many people that have contributed to the success and the stance that we are today as a greater ecosystem and looking at Bitcoin layers. And one of the most important moments that we did have in the industry was the launch of Bitcoin ETFs. And that came January 2024 with over 10 and rising spot ETFs that went active. That said, this was a large undertaking. It was discussed for what seemed like forever and took a ton of time. No one knew exactly why, but wanted to get each of your opinion as to why was the journey towards the launch of these spot ETF products so complicated? Was it more regulation? Was it more technically driven? What was the complication that made this journey so complicated? Ryan, let's start with you.
Yeah, it certainly was a long journey. I think the first spot Bitcoin ETF application was submitted to the SEC back in 2013. So this was a 10 plus year journey to get to where we are today, where we have 10 spot Bitcoin ETFs trading. They have 10 plus billion in assets under management, setting records in their first month of trading. So it's been a really exciting journey. I think the path to get here was so bumpy and maybe so long because of the regulatory hurdles we had to go through and because of just how new of an asset class crypto and Bitcoin is. I mean, this was invented in 2009. ETFs have only been around for about 30 years. So you have these kind of two types of assets emerging almost in parallel. And ETFs really didn't start getting popular until the early mid 2000s. And so I think because of that, it just took a while for us to get there. The Bitcoin market had to mature and had to get to a place where regulatory agencies felt comfortable with being able to surveil the markets, being able to ensure there wasn't manipulation. And, that takes time, unfortunately. The traditional system, the governments move slower than technology, slower than the crypto industry. And so because of that, it took us some time to get here. But ultimately, we brought these things to market and they've really, I think, blown all expectations out of the water. And I think Wall Street's now awake to what Bitcoin can do for a portfolio, what Bitcoin is as an asset, and it's getting really excited about it.
Yeah, I mean, I think you're starting off. I'm seeing shaking heads across the panel, so I want to make sure everyone gets additional time to talk. I mean, 10 billion plus in AUM around these is huge, and again, just in 4 short weeks. We also have BlackRock today, who's hosting an institutional digital asset summit as well. So it seems like there's momentum. But Ellie, want to come to you next, and then Chiente to get your thoughts on the same question.
What's fascinating with Bitcoin is that you have to look at the technology and the market structure to understand the evolution as to how we got into having finally a spot Bitcoin ETF. And when you look at the technology, it took about 12 years for Bitcoin to have 300 million people globally having access to crypto assets, and mainly actually Bitcoin and then the long tail. But for the internet itself, it took about 15 years, right? So when it comes to the technology is moving a lot faster when it comes to the adoption life cycle compared to the market infrastructure. And the reason is because people were able in the past to have access to crypto assets and Bitcoin through platforms like Coinbase and Kraken and over crypto assets, exchanges. But here, when you think about exchange-traded products or exchange-traded funds, they allow people to have access to the same assets, but in a way that is comfortable and similar to them when they want to buy over asset classes like equities, fixed income, and over strategies. This is a way for them to be comfortable with this asset class with the same tax reporting and accounting system as any other investable products. And for that to happen, we needed to have the market structure to be ready. First with the futures market, as well as, of course, then the spot market to be one-on-one correlated, such that the regulators are comfortable with this asset class and seeing some maturity there. And you can see that the futures market is always a lot more predominant for any other asset classes, including even commodities, compared with the spot markets. And you could see now today that the CME is actually the world's largest futures marketplace in the world, beyond even like Binance and OKX and any other crypto native marketplaces. So that infrastructure here needed to be ready so that people can invest safely into this asset class. But the technology adoption is just incredible, outpacing already the adoption of the internet itself, which is a testament to why this asset class is here to stay.
I want to take a different view of this. I mean, the journey of Bitcoin ETF, I would say, is plagued by a series of unfortunate events. And would like to remind everybody what macro environment we have been and where we are right now. If we all remember, the majority of G20 central banks have been going through decade-long of an easing cycle, monetary policy-wise, and to the point that become too loose. The major economy was swamped with easy money. Everywhere in the financial market, you have the over leveraging. Now suddenly COVID happened, inflation rose, and the central bank had to hike really, really fast to fight the inflation. And what we say that, when the tide fall, you see who swim naked. Remember just short time ago, we had Celsius, 3AC and FTX. I think all these have plagued really the development and approval of the Bitcoin ETF. At the end of the day, regulators, first principle, why are they here? What are they protecting? Two things. Number one is they have to avoid systemic risk. And number two is they have to protect the retail users, retail investors. Really, ultimately, you can look at all the regulation, financial or market related into this category. So if you look at crypto market, even Bitcoin as a blue chip of the crypto, there are some market manipulation, the price volatility, and the untested nature of the blockchain technology, I would say. So I think that was the reason why it had taken so long.
Well, and with that point said, Chiente, maybe looking quickly ahead. I mean, we took a long time to get here for these products, and they've only been out for, again, a couple weeks now. We've got the Bitcoin halving event happening in April 2024. With that said, and Ryan called out the stat of $10+ billion having poured into these, what may be the impact going forward with new market events, hopefully all more technically driven in terms of the Nakamoto upgrade on stacks to many others that are coming to market as well, and the halving? What does the next 12 months look like?
So, one always want to draw the analogy from the history. I think a good report I have raised from Galaxy, 2004 was the introduction of gold trust, which is one of the first spot gold ETF, right? By the way, the market was very skeptical about it as well. But if you look at now, 20 years later, this is one of the biggest ETF commodity-wise. It has more than 56 billion, right, AUM-wise. So I think that's number one. But gold is not a perfect analogy to Bitcoin. I think you rightly point out it's about the halving. I would say that the Main Street haven't realized about the fixed, inflexible supply of Bitcoin. A halving is coming. What does it mean, right? So currently, I think about 93% of total Bitcoin have been already mined, with an estimate of 30 million Bitcoin at the moment is free float. So that's the supply we are facing. Now, if you look at the halving is April 2024, it will reduce the mining reward from 6.25 to about 3.25-ish per block. Right? So if you look at this, you look at Bitcoin ETF at the moment, but correct me if I'm wrong, Brian and Ellie, you know this better. They are the ETF, the Bitcoin ETF holds around 720,000 Bitcoin. This is only 5.4% of the free float. It's really not that big. So number one, the demand will increase, but number two, the supply is being intensified, squeezed. So that's the situation we are facing right now. So, and I'm not going to pass the ball to Ellie and Ryan.
Yeah, sure. Ryan, you want to go ahead?
Yeah, sure. I mean, I think that's right. We're entering this period where we have increased demand for Bitcoin coming from the largest financial institutions in the world. RIAs, financial advisors, big banks and financial institutions like this, they manage trillions of dollars in assets on behalf of investors, and they just now, really for the first time, have open access to Bitcoin through these ETFs. And so you're going to have a huge increase in demand. That's going to create some demand shock, and at the same time, that happens to align pretty closely with the next Bitcoin halving in April, which is going to have a supply shock that goes the other way. And I think those two dynamics really should have a strong impact on the price of Bitcoin. I mean, just like other commodities, the price is set by supply and demand, and big increase in demand, halving in the new supply that's coming to market. To me, that just sets up a really interesting dynamic for where this could go. And I agree. I think most of the mainstream investors don't understand this dynamic around Bitcoin and don't understand that free float and limited supply that Bitcoin has. And I think that's just an amazing opportunity and an amazing setup.
Yeah, I couldn't agree more with you guys, especially when the beauty of like the Bitcoin blockchain is the transparency, right? And once you have an army of crypto specialists, like 21 Shares, being able to build out the dashboard for you to see in real time when exactly the halving would happen. We actually have a countdown on Ndinga Analytics where you can see when the halving would happen depending on the settlement time of the Bitcoin network. It happens on average every 10 minutes, right? But we know that sometimes whether the market is saturated or not, we could also see no longer or faster settlement times. What is really important about the halving is two things. Number one is the inflation rate, right? The inflation rate is going to get cut significantly below even 1%. So when you look at the CPI numbers today on Trueflation, for example, the CPI numbers in the US are well above 1.7%, according to Trueflation, and Bitcoin is way below that. The second thing is past performance, as you guys know, is not indicative of future results. But we've seen that historically in the cycles, Bitcoin always reach a new all-time high 6 to 18 months after the halving. And the cool figures that we have actually at 21 Shares is when you look at the drawdowns of Bitcoin as well, because it's also equally important to look at the other side of the performance, only 43 times in 10 years, Bitcoin dropped by more than 10%. So that's less than 2% chance of happening every single quarter within 10 years, right? And a drawdown of more than 20% happened only twice in 10 years. So you have once in every 5 years, a chance to experience a drawdown of more than 20%, which is the equivalent of the bear market. And the good thing here, it shows that we're seeing a pent-up demand for all of these ETFs right now. When you look at some of these numbers for them, some of these inflows is just at an all-time high compared with any other asset classes that we've seen for 30 years for the ETF markets. And that's significant. It shows again that moving forward, we're going to see more and more platforms, wirehouses allowing these ETFs to be traded for so many people that have been waiting for that for so many years, but they were not allowed to invest because it wasn't falling under the mandate to actually access to Bitcoin through other platforms than ETFs. So this is the exciting part where we're seeing that now more and more people are going to be able to have access to Bitcoin. Then most importantly as well, other jurisdictions are going to open the doors to these kind of products moving forward as well. So we're looking forward to the second order effects of the ETF approval in the US that can, also influence other jurisdictions, mainly in Europe too.
So access to Bitcoin. One thing I wanted to bring up, we talked a little bit about this pre-panel. There's also been much debate around this topic, and that is the custody that these products have, or how they are handling custody as well. And so wanted to get Ryan, Ellie, your opinions around the debate of custody. How does custody work from a technical standpoint with some of these ETF spot products? Who holds the keys? As we know, I saw a few, and if not almost all of the ETFs are now actually showing the wallet address to where and how the assets have been managed too. But would love to get your opinions as how you and your teams have looked at custody in some manner.
Yeah, I can go ahead and take a stab at it. I mean, I think the best way to think about using a regulated third-party custodian is that the assets are sitting in cold storage once there are inflows into the ETF. And you can think of it somewhat like a multi-sig between multiple organizations. In order to move the Bitcoin, it requires many people to be involved that have that have certain responsibilities across both organizations. And these are regulated custodians in the US. They fall under very strict regulatory guidance and regulatory responsibilities. And I think that's really important. So it's not like Bitcoin's being held in some hot wallet for when you're using a third-party custodian like Coinbase. This is a publicly traded company in the US. Again, these are regulated third-party custodians. And what's I think really fascinating is that we publish the Bitcoin address for our spot Bitcoin ETF holdings. And so you can see on chain in real time where those Bitcoin are sitting. You can see as an investor where that Bitcoin is sitting. I think there was a lot of kind of FUD around that element. Like, how do we know the ETFs will actually be purchasing the Bitcoin that they're purchasing? And I think to debunk that a little bit, you just need to understand that ETFs are relatively simple vehicles. They take dollars in, they go and purchase the underlying asset, they move that asset into custody, and then once there's a redemption, they reverse that process, and there's really not much more to it. So, I think that a lot of investors who don't want to worry about having hot wallets or even a ledger or some kind of hardware wallet where they have to punch in the little buttons and codes every time they do a transaction. I think for them, having a low cost alternative like a spot Bitcoin ETF that handles security through regulated third-party custodians is a lot better of an alternative than using a centralized exchange or the fear that might come with self-custodying on your own.
Yeah, I couldn't agree more. We've been running spot crypto ETFs or ETPs in Europe for the past 5 years. And again, for the audience, the assets are held in cold storage, ring fenced away from the balance sheets of the sponsor or the issuer, held in cold storage in geographically distributed vaults, so that we provide the heightened security for the investors when they get into this asset class. And we've been doing that for 5 years. And this is the same playbook that we applied as well with our infrastructure to the US market with a third-party custodian. Again, when we think about, these exchange-traded products, they're really trying to fight as much as possible the risk of, counterparty risk, right? Because they allow people to be comfortable with this asset class with any other investments that they have, like commodities, for example. This is just the same architecture, the same structure that asset managers have been using for so many years. And that is just applicable now with Bitcoin, but also with a novel technology that we haven't seen before with any asset classes. And again, as Ryan mentioned, with blockchain transparency, you're able also to track the balances over time and provide more transparency to the investors, which is a a net plus for sure.
And Chiente, I want to come to you on a question that you and I have discussed at length, and that is some of the rising decentralized pegged assets, such as SBTC. Could the debut of something like SBTC or otherwise impact these types of products, the Bitcoin ETFs? And if so, how?
I think, again, going back to the fundamentals, right? You want people to desire this asset. You want people, and people, I mean, not just retail, but also pension fund, endowment, money manager who take care of our pensions, our children's tuition. You want them to desire this asset, which is called Bitcoin. How do you make an asset desirable? If it's pure speculation, it will be short-lived, right? And we in the Bitcoin space, we keep on fighting, say Bitcoin is not a bubble, Bitcoin is not tulip, because bubble bursts, Bitcoin have been proven historically over and over again to survive. Now the big question is, okay, how do you make Bitcoin, this asset, productive? If you make it productive, it will be desirable. Holding Bitcoin is boring, just waiting the price to appreciate. So, and then here is a statistic that always encouraged me and my team to work 24/7 in this space, is that at the moment, we, the individual, the retail, we hold the majority of the Bitcoin, right? The significant portion of a Bitcoin are held in very small balances addresses. So if you look at this, I think I got some statistics like 74% of Bitcoin is held in the balances that are smaller than 0.1 Bitcoin. Another 17% is held in the Bitcoin balances between 0.1 and 1 Bitcoin. So we are talking about individuals, we call it retail, but individuals here. Okay, so now if we all agree, we want to make Bitcoin productive, desirable, we want to make sure that these individuals are excited, want to move their Bitcoin. Because if you don't move, it's like my mom's cash under her pillow, completely useless, right? How do we do that? Number one, you want to provide them the security. When you move the Bitcoin from the cold wallet to a hot wallet, right? For example, moving to SBTC, is secure, it's safe. Number two, you want to provide really good user experience. I mean, at the moment, I think Eddie said that you have to put all these keys, right? You most likely have a post-it somewhere with your keys. My mom's not gonna do that. So that's the user experience. But number three, I think most important, that's what Alex is here for, is that you want to give people a reason. Why do they want to move their Bitcoin? To come to whatever platform it is, once they feel safe, secure, easy, what do they do with their Bitcoin? And I think that's really our focus right now, is to roll out a suite of Bitcoin assets, right? They have to be yielding, they have to be, making sure there's a reason. You explain to people where the yield come from. The yield come from, again, finance 101. Most of the yield come from lending and borrowing, this kind of activity, financial activity. And SBTC is going to play a very, very central role here, because at the moment, as I see, is a best designed bridge between hardware Bitcoin to hard wallet, cold wallet Bitcoin to hard wallet Bitcoin. With that, you can use all the technology, smart contracts, for example, from Stacks, to come up with lending, borrowing, to design a stable coin at RWA, etc., etc. Then the Bitcoin economy will thrive. Then people want to hold this particular asset. So that's my very humble point of view.
Well, on that, you mentioned yielding, and when we look at emerging markets and access to yielding products. One thing that also comes to mind is decentralized finance, or DeFi protocols and applications. With the introduction of liquid stacking in the Stacks ecosystem and staking in others, is this something that those that are participating in the ETF spots product sets could maybe utilize in some capacity, in your opinion, quickly as well?
Yes, I just want to say that it's a funny history. My CTO, Chiente, and we came up with the first volatility ETF many years ago. So we grew up from the ETF space, and we have seen the evolution of ETFs. First is a SPA, later it will be a 2x, 10x inverse, and yield the ETF. Why? Because Ethereum by nature is a yielding asset, crypto. So very naturally, one of those big houses will come out, most likely Ryan or Eli will come out with a Bitcoin yield ETF. Then you have to ask yourself, where does the yield come from? And very naturally, it will come from those financial activities I just mentioned, lending, borrowing, on-chain in particular. Why on-chain? Because there's no counterparty risk. It's much more efficient. So yield that is remaining is much more interesting for the users. So definitely, I think this is the next step to go.
I would agree.
Go ahead,
I would agree with what she just said, because when you look at the European markets, we launched the world's largest product suite of crypto ETPs, and we have baskets, we have shorts, we also have launched the world's first staking ETP as well. And I think it shows again the plethora of products that could be available for people within their brokerage account or their banks as the asset class matures, especially when the correlation between all the crypto assets is going to decrease significantly, especially on the downside when we measure the Sortino ratio. It's important to see the diversification of the crypto assets within baskets, and also thematic as well, right? When we look at DeFi, it's a more than $50 billion vertical within crypto already. So there is also appetite for baskets as well. But again, when it comes to the yield, as Chiente mentioned, it's very important to have the right disclosures and a disclaimer to make sure that the investors understand the risks ahead of time, whether it's smart contract risk or platform risk, counterparty risk, or whatnot. It's really important to have the transparency on where the yield comes from. And I think, all these new primitives that are native to Bitcoin as well as stacks are actually very interesting. But again, for very large investable, infrastructure and products, it's important to look at the liquidity. It's important to look at the custody support. Important to understand the risk as well. There is a lot of education to happen before it gets to that stage of being accepted as an exchange-traded product, whether it's in Europe, globally, or any other jurisdictions.
Ryan, anything to add, but also your closing thoughts as we are now seeing this demand of institutions grow, new technical projects and experiments launching on a daily basis across the Bitcoin ecosystem. Where do things go from here in your closing thoughts?
Yeah, I think that's right. Exchange traded products are really about providing easy access to a wide variety of investment vehicles, whether that's index-based or rules-based strategies, whether that's spot strategies, lending, short, long, et cetera. So I think if there's demand there, we'll certainly see products come up and meet investors with that vehicle. And so I think that we're just getting started. I know we're really in the early innings of not only this next cycle, but the evolution of Bitcoin as an asset class. I think the ETFs really weren't the finish line. They're really more towards the starting line. So I'm really excited about what's ahead. I'm really excited about the new use cases that are popping up on top of Bitcoin, whether that's ordinals, whether that's stacks and protocols like Alex. And so, yeah, really excited about the future. I think we're in the early innings still.
Wonderful. Ellie, same to you. Closing thoughts on where do we go from here?
I think where we go from here is a lot more adoption. You're going to see a lot more people being comfortable to understand how Bitcoin works, becoming more educated as well with simplified content on the back of these investable products that we're seeing in the market, especially in the US. You're going to see more regulatory sensitivity around this asset class as well to balance out investor protection and galvanize innovation in this asset class. We're seeing the power of so many jurisdictions trying to be the crypto hub, whether it's in the UK or even like Hong Kong or Switzerland. or even like the US right now, we're seeing some sensible regulation as well. And I think it's a good thing for the industry. And it sparks the imagination and curiosity of so many people to understand how this works. And I think that's super exciting for sure.
Chiente, close us out.
Bitcoin was a funny internet money. We were regarded as scammers last year, and we have experienced that the Bitcoin journey from a mere store of value to now a platform capable of asset issuance, technological advancement like Taproot upgrade, ordinals, etc., etc. And Bitcoin, as I have always said since day zero, is going to be, and it is right now already, the most viable alternative to any fiat system. And that's why we are all in this space. Thank you, Kyle.
Thank you very much, Chiente, Ryan, Ellie. Very much appreciate your thoughts and insights. To our listeners, again, today's conversation was for educational and informative purposes only, not financial advice. Please do your own research. Again, thank you all very much.